Hey Bowtie Nation, Joseph Hogue here with Let's Talk Money and one of my favorite trading strategies in today's video. Research has proven that volatility increases around earnings announcements, and up to half the year's total stock market returns are produced around the handful of months that companies are reporting their profits. That's during normal years, and we know 2020 has been anything but normal. We're coming up on third quarter earnings, and it could be a game changer for stocks. That's why for this video, I dug into the stocks I watch and other research to find the 5 stocks to buy before earnings releases. We'll start by reviewing where the market stands going into third quarter earnings. Then I'll show you the 3 sectors I'm watching for potentially huge market moving surprises, and then reveal those 5 stocks to buy. We're about to get started, but if you're not part of the Bowtie Nation yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, the market boomed after second quarter earnings proved the economic rebound. Stocks in the S&P 500 were up 15% in the 2 months after earnings started, and the tech-heavy NASDAQ jumped 20% before falling into September's weakness. 84% of the companies in the S&P 500 beat expectations for earnings, with some sectors doing even better than that. More than 9 in 10 companies in the IT, materials, healthcare, and industrial sectors reported second quarter earnings above analyst expectations. Just 3 in 100 tech companies failed to meet or beat earnings estimates. But the big question mark is whether these third quarter earnings are going to be just as positive. And most economic data has stalled since June, with a summer jump in those COVID cases. This graphic shows OpenTable restaurant reservation data in purple, still down 40% compared to last year. Retail store traffic is down between 10 and 20%, and all these have just stagnated since mid-year. Put it all together, and Wall Street analysts expect companies to report a decline of 21% in earnings when those Q3 reports start coming out this week. That would be the second largest year-over-year decline in earnings since the second quarter of 2009. Worse still, though, is just the uncertainty. A record number of companies have pulled their guidance this year, so we really don't know what companies are going to report. Looking back at the second quarter surprises, nearly 3 in 10 companies in the real estate and energy sectors surprised to the downside, missing their profit expectations. But there is still an opportunity to find those stocks to buy ahead of positive surprises. Nearly 50 companies in the S&P 500 have issued positive guidance, meaning they've pre-released some information that points to higher than expected earnings. I'll be using the Webull app to show you how to find earnings information for stocks, including past surprises and when a company is going to report its next earnings. I'll show you how to use the app to find earnings data and then surprises on each stock. Click through the link I'll leave in the description below, and Webull is going to give you a free share of stock worth up to $1,600 when you make your first deposit. Now, I want to look at the big picture first before we get into those 5 stocks to buy. We'll first look at how to find stocks for earnings surprises and the sectors that I'm watching right now. And when we're talking about earnings surprises, being able to beat those expectations for profits, a lot of times what we're talking about here is going to be value stocks. Those stocks trading cheaply, and ask yourself, where is the market wrong on those earnings and the stock valuations? So it's helpful here to look at the sectors of the economy and their valuations and where analysts think the greatest value is going to be over the next 12 months. This is a chart from FactSet on sector valuations that I look at, and here you see in dark blue the price to earnings ratio for the stocks in each sector. So technology, consumer discretionary, utilities, and so on here. This is how expensive stocks are trading right now versus analyst expectations for earnings over the next year. In green then, you see the 10-year average PE ratio for each sector, and the first thing that just jumps right out is how expensive stocks look compared to that long-term average. I've added the percent a few of these sectors are over that long term. For example, stocks in the market index, the S&P 500, are trading at 21.6 times forward earnings. That's a premium of 39% over that 10-year average of 15.5 times earnings. And so some sectors here are just undeniably expensive. Stocks in the consumer discretionary sector are trading at nearly double their long-term average. Tech stocks are trading for prices that are 66% higher than that 10-year term. But if you look to the right on the graph, you see a few sectors that aren't ridiculously expensive. Healthcare and financials are both trading within about 10% of that long-term average. Profits on energy companies have fallen so far that the sector has negative earnings and no PE ratio. So for these third quarter surprises, I'm going to be looking in these 3 sectors for potential stocks to buy in energy, healthcare, and financials. We'll start with the financials and 2 stocks I'm watching in the space. The sectors have really been hit hard this year from different angles. The first, that general economic weakness has scared banks into cash protection. So they're shifting a lot of their earnings into the loan provision accounts and dialing back on their lending. Second, though, the flat yield curve with long-term rates not much higher than those short-term ones just means it's really tough making money lending. And when you're paying those short-term rates and then lending out on the 15 to 30-year terms, there's just not much profit margin in there. So Voya Financial, ticker VOYA, is a $6 billion services company providing investment, insurance, and retirement solutions. If we click on the financials here in the menu, we can see that the company's missed earnings pretty badly over the last quarter. Earnings per share were about 80% below expectations due to a $93 million hit in the individual life segment that it's been trying to sell. Before last quarter, the company had done pretty well meeting those expectations, though. We also see here the company is expecting to report earnings sometime around the 3rd of November, expecting to post $1.32 per share. If we scroll down further, we can see expectations and earnings reported for the last 4 quarters, and you see that just that bad bump last quarter. Analysts downgraded their expectations for Q3 to $1.32 per share, and I think they may have gone too far on this. Investment management fees were up 7% and retirement fees up 10% over the past year to the second quarter, so a lot of that business is just running still pretty well. Besides just some better financials coming through in the third quarter report, an update to that planned sell of the individual life business could spark a rally in the shares, with sales expected to bring in about $1.5 billion plus their cost savings. Analysts have an average target of $61 per share, or about 24% upside from here. Huntington Bank shares, ticker HBAN, is a small regional bank with branches across 8 Midwestern states. It beat earnings by a wide margin last quarter, posting 13 cents per share in profits against expectations for just 4 cents a share, though its track record for earnings is a little spotty. It missed expectations in the fourth and first quarter, but beat again in the third quarter of last year. Now, like all banks, earnings are expected to fall off a cliff this year, about half of where they were last year, but I think there's a lot of reason to be bullish on this sector. Shares of Huntington are down 33% this year, but pay a 6.3% dividend yield. The acquisition of First Merit in 2016 gave it better scale, and the investment bank HSE acquisition in 2018 gave us some great capital markets exposure. Now, this growth has really helped it to improve profitability and cross-sell into some of its products. The bank increased its loan loss reserves to $1.7 billion last quarter. That's double where it was last year at $800 million. Now remember, that's just the cash account that the banks are holding to cover those higher loan defaults just in case the recession gets worse. The way the economy is going, though, I don't think it's going to need that much and might be adding more of that back into earnings soon. Shares here trade for just 0.91 times book value versus a history around 1.4 times book, so basically a 35% discount on that fair value. Analysts have price targets ranging from $10 a share on the low end to as high as $12 each over the next year. In the healthcare space, a lot of stocks have been hit as the world shifts to a singular focus on COVID. Elective surgeries and other procedures have been all but canceled, and even pharmaceutical sales have been a little sluggish this year. And there are a lot of good names here, but I'm going to go with CVS Health, ticker CVS, for my earnings surprise pick in healthcare. The company has a history of beating expectations and blew by estimates last quarter by 37%, reporting $2.64 instead of the $1.93 that Wall Street was expecting. Now, expectations for the third quarter, which should be out on November 6th, are subdued to say the least. Analysts are expecting earnings of just $1.32 per share versus $1.84 reported last year, and the company should have no problem beating this. Despite those lowered expectations for Q3, CVS is expected to report $7.23 per share earnings for the year. That's up 2% from last year, and an interesting disconnect for a stock that's down 20% this year. Just as important as third quarter sales, though, I'm expecting management to provide some kind of upside outlook to its future sales around the COVID vaccine distribution. That's something I think could really juice the top line, and that's along with a super cheap valuation at just 10 times earnings, and could get a quick pop here. Analysts have price targets from $72 a share on the low end to as high as $104 each over the next year, so even that low target is 20% higher. The third sector I'm watching is going to be energy, and this is just a question of less bad for earnings because the environment really hasn't improved much. Demand is still weak, but it looks like production is coming down faster than expected, so that might support prices from here. The hope here is that earnings show companies are more aggressive at their cost cutting, so the prices are less negative than expected. One of the few oil companies to remain profitable here, Diamondback Energy, ticker FANG, is a $4.6 billion explorer in the Permian Basin with 1.1 billion barrels of proven reserves. Now, the company beat expectations last quarter to report 15 cents a share versus estimates for just 2 cents a share earnings. And it's beaten in 3 of the last 4 quarters and is scheduled to report Q3 on November 3rd. Expectations for this quarter have come down to just 45 cents a share versus last year's profit of $1.47, and I think there's a great chance that the company beats that by a wide margin. Diamondback has been aggressively cutting this rig count to bring down those costs and just protect the cash flow. Capital spending is down 35% from its original 2020 plan, and operating costs are looking really good. Management reported cash operating costs of just $8.16 per barrel in the second quarter, which is among the lowest in the industry. Those costs came down 20% in the second quarter alone and should help to beat this quarter as well. Now, those lower costs have helped management commit to its $1.50 per share dividend for a 5% yield, and the company is one of the best positioned for that eventual rebound in oil prices. Wall Street analysts have price targets from $44 a share to as high as $72 each, so another stock here where even the lowest target is above the current price. EOG Resources, ticker EOG, is another producer play, though larger than Diamondback, with a $21 billion market cap and 3.3 billion barrels of proven reserves. Now, the company missed expectations last quarter, reporting a loss of 23 cents per share against estimates for just a 5-cent loss. It also missed in the first quarter, so the track record here is a little less certain. Now, still, the expectations for Q3 earnings are for just 9 cents a share in profits. That's versus $1.13 reported last year, so drastically lower, and maybe low enough to allow management to beat these estimates easily. You can see how bad the earnings revisions have come down, though, here, comparing estimates for 65 cents a share this year against $4.98 per share in profits last year. This is an 87% drop here, folks, and tells us why shares are down 59% this year. Still, the company has that cash flow to maintain its 4.2% dividend yield, and the shares are priced perfectly for that long-term rebound. Cash operating costs last year were down to $8.76 per barrel, so a little higher than what we saw at Diamondback, but still among the lowest in the industry. And this company has some premium assets in shale oil that should be unlocked when prices recover. Analyst targets range from $52 per share to as high as $85 each for a potential return of 132% over the next year. Click on the video to the right for 5 stocks with massive insider buying. 5 stocks to buy for piggybacking on those insider secrets and insider trading. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.